Hello, my name is Jack Elder, Senior Director for Advanced Planning at Comprehensive Brokerage Services. This week and for the next couple weeks, we're going to talk about split dollar. Why split dollar? Because if you have clients that have used or have earmarked their gifting capacity, whether that's their lifetime exemption or annual exclusions, but they still need coverage outside their estate, split dollar is essentially the best tool to accomplish that goal. So today we're going to talk about loan-based wealth transfer using split dollar. So client profile, families concerned about the estate tax. Like I said, they've either used or have earmarked their lifetime exemption, and the annual gifts either aren't sufficient to cover the premiums or they're being used for a separate gifting program. So again, we're focused on wealth transfer. Split dollar can also be used in the business scenarios, but today we're going to talk about wealth transfer as well as next week and the week after, in specific loan-based split dollar. Next week, we'll talk about non-equity collateral assignment. The CA there stands for collateral assignment. That's a type of split dollar transaction for the private scenario, meaning non-business related. And then the following week, we'll talk about the services we offer with respect to split dollar. So let's talk about loan-based split dollar. So the parties to the transaction are the grantor / lender, the trust / borrower, and the trust beneficiaries. Essentially, it's a family loan. The grantor makes an agreement with the trust to advance premiums for a life insurance policy in exchange for interest and the right to be repaid. If the trust is a grantor trust, that interest would be income tax free because that would be considered a transaction with itself. A grantor trust is a disregarded entity with respect to the grantor. So the interest would be income tax free. The repayment is a note receivable in the grantor's estate and is eventually paid off by the cash values of the life insurance policy, the death benefit, or other trust assets. So it's really a circular transaction between the grantor and him or herself and their grantor trust. Now, it doesn't have to be the grantor that is the lender. It could be a relative, family member. It could be another trust that's already outside the estate. This is very powerful because that note receivable is also outside the estate. So that's pretty abstract. So let's look at a specific example. In this example, we used a demand note. There's two types of notes you can use for intra-family loans or for split dollar loans. One is a demand note. The interest rate's published by the IRS every July. For the term notes, and you see them there, 3 short, mid, and long-term rates, published monthly by the IRS. We typically use a demand note for loan regime split dollar, but there could be good reasons to use a term note as well. You have some flexibility there. So with the example, let's take a real case, Mr. and Mrs. Tyson. They were 55 and 51, lived in North Carolina, had 2 adult children. He was the founder of an engineering firm valued at $28 million that was kicking off about $1 million of income. That's what he was taking from the business. His assets under management were $5 million. He was advised, rightly, by his attorney to take advantage of today's exemption at $24,120,000 to move future appreciation in his engineering firm outside the estate. However, that left almost $9 million in his estate. And the question was, how will that $9 million be taxed? Well, the first thing I pointed out, it's actually not $9 million. If you grow the Tyson's estate at 4.5% for their joint life expectancy, it's actually $31 million. At 40%, that's an estate tax of almost $12 million. Well, how are we going to address that? We are going to address that with a no gift solution, and that is loan-based split dollar. So let's look at the lead up to the case. The advisor told me that he knew enough to be dangerous. I spoke with the attorney. The attorney was familiar with split dollar, but had never done the transaction. So while we were underwriting the client and shopping carriers and doing exhaustive case design work to make sure that the split dollar arrangement we put together met their goals, I was consulting with the attorney. That was multiple conference calls. I provided sample documents that he used as a launching point for his drafting. And we talked about how the split dollar would be administered in the future in great detail. So let's see what we came up with for Mr. and Mrs. Tyson. As I showed you earlier, they're going to projected to have a significant estate tax, even with the planning they've done. So they purchased a $10 million policy. We designed it as a 10-pay, $174,000 a year. They did seed the trust with a $15,000 gift. That's not necessary in a split dollar arrangement, but the attorney insisted on it because he wanted to allocate GST exemption. I thought it was a great idea. Had no complaints about that. They loaned $5 million. Essentially, they retitled assets. $4 million of their AUM got retitled into the name of the trust. That was not a gift. It's a loan. And in this case, it was a lump sum loan, but sometimes we use annual loans. We have flexibility there. The interest on we use a demand rate, so the lowest possible interest rate as published by the IRS, and then we just assumed it increased by 10% every year to forecast. As you can see, we're actually going to pay interest each year, and that interest will be collected by the lender, the grantor, Mr. Tyson, but not taxable because it's a grantor trust. Sometimes we accrue the interest, sometimes we pay the interest. It really depends on what we're trying to accomplish for the client. There's flexibility there. So I mentioned that there's a note receivable in Mr. Tyson's estate. The first $4 million, if God forbid they died in a common accident before this note had been paid off, the first $4 million would go to pay off that note. That note's in his estate. As the lender, he stands in first place with respect to the policy's death benefit and cash value. The trust is in second place. The assets were, the advisor told us to assume 4.5% rate of return. So we did. We grew the assets in our model at 4.5% minus the premium, minus the interest, beginning of year, end of year. And we were able to forecast pretty easily with a little room to spare that $4 million loan would be paid off in year 10. Now, that loan could have been paid off from the death benefits. It could have been paid off from the policy itself, from the cash values of the policy. There's flexibility there. In this case, we use the assets themselves to pay off the debt. Now, you might be thinking, gosh, that's a lot of hoops to jump through for a transaction. Yes and no. There are some T's to cross and I's to dot, but what did we really accomplish? Well, with a $15,000 seed gift, we were able to put $10 million in a trust outside the estate, which, oh, by the way, at their joint life expectancy, had an internal rate of return, an income tax-free rate of return of 7.94%. So again, let's talk about the client. Families concerned about the estate tax. They've used or earmarked their lifetime exemption, and their annual gifts aren't appropriate for insurance. So we, as a firm, have deep experience with split dollar. I hope that this presentation demonstrates that. Split dollar is product and carrier agnostic, and it has near endless flexibility. We have sample agreements. We provide split dollar audits on existing plans, and we'll also provide administration services for new split dollar plans. So if you have a client where this makes sense, we'll handle the administration for you down the road. If you have a client that has an existing plan in place, let's talk about providing administration for those plans as well. Our split dollar services are an example of the type of advanced planning we provide the advisors that work with us. If you have a client that needs advanced planning, please don't hesitate to give us a call. We'd be happy to assist you. There's my contact information. And with that, I hope you have a great day. Thank you very much.